Body. He likes to say the Williams education prepares you for nothing in particular, which is why it's an ideal preparation to be an entrepreneur. I always like that one. All right, we're going to get right into it. I've been asked to try to cover a lot of ground, and what we're going to do is rather than have everybody respond to every question, we're going to kind of mix and match here a little bit. But to get started, I'd like everybody to, and you will have to share microphones, tell us what your major was when you were here, when you graduated, where you live now, and what your job is.
All right.
Yeah,
Isabelle?
Yeah.
Okay, sounds good. Hey everyone, thanks so much for having us, and to your organizers, thank you. My name is Isabelle Phelps. I'm a partner at a seed stage venture capital firm in New York City called Lerer. We're one of the most active seed funds certainly in New York. And I'm sure get into backgrounds, but at the high level, graduated in 2020 with a degree in political science from Williams, and have spent time in San Francisco and Boston, but been in New York for almost 6 years now. And the high level, just to give a sense of, again, I'm sure we'll go into this, but what we do at Lerer, we lead or co-lead seed rounds, so rounds of anywhere between maybe $1 to $4 or $5 million in this market, and work closely with entrepreneurs in helping to both finance, but then also build their businesses post-seed as well. Work closely with some of those in the panel.
Thanks, Isabelle. Brad?
Of course.
Brad Svrluga, class of '95. Econ major, almost a chemistry double major, did a summer in a chem lab, decided that was not my future. Co-founder and general partner at Primary Venture Partners, which is a very friendly quasi-competitor friend of Lerer. Hippeau, certainly in the New York. I would say the two of us are probably the two most active seed stage investors in our firms in the New York City metro area. Started that firm 9 years ago, and what was the other question? Was that it?
Where do you live?
Oh, where do I live? Here and there. So my wife and kids, 2 sons, live full-time here, and I spend about half of every week in Manhattan. And
Great.
that's a good formula if you can pull it off.
Margaret?
Hey, I'm Marco DeMereles. Can you guys hear me?
Yes.
Great. I was an economics major and leadership studies minor, but like Brad, dabbled in a bunch of other things, including bio, which I still think is my first and true love. I graduated in 2010 and have only done one thing, which is invest at the intersection of technology and healthcare over the last 12 or so years. I live in New Jersey, 20 minutes outside the city, with my wife and our young son.
Jim?
Thank you. So I had the great distinction to be a JA when Mike Curtin was here, getting his bad grades in Math 107. So that was, saw him, I would chase him around the log a lot. So that makes me the class of '84. That might be the oldest panelist here. In fact, I think the math will bear that out. Majored in American Studies here and also economics. Ended up, over the next 40 years, basically in a career in research. The first 20 years at First Boston covering energy stocks, and the last 20 years I've been a partner at Sound Shore Management, which is a old-fashioned, long-only investment boutique, and we're down in Greenwich. My wife is here, Evan, and we live in Darien, Connecticut. We had a son who was here, class of 2019. So.
Thank you all. Next, I just want to ask a couple of these venture investors what a typical day is like for them. How much time do you spend on analyzing deals and talking to founders, reviewing legal documents and talking to investors? Just what's a typical day like for you, Isabelle?
Yeah, all of the above. And I would say one of the things I love about my job is that it's always varied. And that's true in terms of the type of work that I'm doing also for us, given that we're generalist investors. We invest across industries and across both enterprise and consumer deals, across kind of different industries and technologies as well. So incredibly dynamic that way. But I would say, typical day is it's meeting with founders, it's digging into diligence, understanding, doing higher level market research, but also doing deeper diligence in specific deals that we're taking a close look at. It's working closely with the founders that we've invested in. So we tend to we work very closely with founders kind of post-investment specifically, and so spend a lot of time working with them. But also getting to know new founders across specifically the New York ecosystem, but across the US as well. And so that's sitting down with people for coffee, it's going to events, it's kind of a varied type of sourcing, but getting to understand where are there new trends or where are those kind of founders building new things that are interesting, but also developing a good relationship with them and better understanding what really drives those individuals too. And then certainly, there's a phase of kind of investing that is legal diligence, term sheet negotiation, a lot of that work that goes on throughout the course of the day as well. So it's a very varied job, as I mentioned. I think it's a great list of kind of some example things that we work on.
Thanks. And Marco, how's it? What's a typical day like for you?
Yeah, so I don't think I shared it, but we are fund one in our life cycle. And so it's a lot around firm building. The highest level there are things you can control, like who you hire, who you take money from, who you give money to, and we try to break up those functions in a way that we're always getting better at it. And so I spend a lot of my time in things like that. And then on the thematic side, so we are a thesis-driven firm. That means different things to different people. But for us, we spend a lot of our time on research. We run really concentrated. There's about 12 or so positions in the fund. And to do that, you better be right. And to be right, it pays to be prepared. And so we spend a lot of our time doing really deep research, relationship building, trying to find a wedge that's unique and ultimately like a great risk reward.
Thank you. Now, something I've realized is a lot of entrepreneurs don't understand or aren't aware of how venture investors actually get compensated. It's not salary and bonus. It's a different structure. And I've forewarned these folks I'm going to ask them this question, but I think it's a good one. Brad, can you tell us how venture capital fund managers get compensated?
Yeah, it's very simple. Our revenue is, as a business, is made up of two things. One, there's a management fee, and this is true of almost all asset management, be it venture or private equity or real estate private equity or hedge funds. There's some version of this. You get paid a percentage fee on all the assets that you manage, and usually in venture it's 2 or 2.5%. So if you have a $100 million fund, you would have $2 or $2.5 million per year. It's that percentage every single year gets paid to the management company, which is the business that actually runs the investing activities of the fund. So, and then that's all you've got to rent space, get on airplanes to go chase deals, pay your team, whatever. All of the activities get covered by that. And so when you're at the beginning, Marco and I both founded venture capital firms. You have no money yet raised, and your first fund is undoubtedly smaller than you would have dreamt it might be. And so you're doing it on a shoestring, very much in a entrepreneur, like an operating company that just raised a seed round. But the upside is, materially attractive because, so if we, again, let's say we raised a $100 million fund, we'd have $2 or $2.5 million a year to run the business, and then we get generally 20% of the profits of the fund. So if we succeed in turning $100 million into $300 million, there's $200 million of gain there, and the firm, the general partnership, will get 20% of that. So that's $40 million of a $200 million gain. Now, it's turning 100 into 300 is not something you fall out of bed and do. It's hard, but if funds that do very well get rewarded very well. But if you want to get rich on kind of guaranteed income, you should definitely get another job. Be an investment banker.
Isabelle, did you want to add anything to that?
No, we're comfortable.
All right. Now, Jim, you're in a little bit different kind of a role, so maybe say how it's different than venture, and how are you compensated?
Yeah, so at Soundshore, we're a value investment firm investing in public stocks. Like you, Marco, we're pretty concentrated. Not as concentrated as 12 to 15, but we've got 35 holdings in the portfolio, very bottom up. It's across the whole market. We do our fundamental research, looking at valuation first, try to figure out which companies are doing the right thing. And then invest in them. Typical holding period for us will be, 3 years. Now the way we get paid, and like Goldman Sachs and their wealth management business is a big client of ours. We've got a big sovereign wealth fund down in Japan. That's one of our big clients, and we also have a mutual fund. For the 18 people that work at the firm, we charge about 60 or 70 basis points on average. And then there are some accounts that like to have a performance fee model instead, so we'll charge them a lower base fee and then a portion of our outperformance. Our goal is to beat the market and beat the value index over time. We've been around for 45 years. We've actually been able to do that over the long haul. So that's the model.
Cool, thank you. Next, I want to learn more about the funds you operate in, and common term that's used, which Mark alluded to, is your investment thesis. And I think each of you operate with somewhat of a different investment thesis. So I wanted to actually ask all four of you to say a little bit about the thesis that you invest with. You start, Isabelle?
Sure. So we are, it's two things. First, just for a little bit of background, Hippeau, we're currently investing out of our 8th fund, which is, it's 150 million or so. But we started investing over, I guess, 12 years ago in New York City. And I think part of the fund's thesis at that point was that New York City as an ecosystem was relatively undercapitalized in terms of kind of tech investment in early stage tech companies. And so the firm was really started with that thesis that there was a lot of opportunity there. And so, the rise of the fund and really where we continue to be really focused in the New York ecosystem, a lot of that, the thesis around that is that there's a lot of opportunity there, and we've certainly seen that bear out. I mean, Primary and Lerer have been very successful investing in New York-based companies. The firm as a whole, though, is, and I mentioned this at the outset, we're a generalist fund. So that means that we're not kind of going deep like Marco just described in kind of developing a specific thesis around where a market's headed, or kind of going deep within a specific sector to really think about what's kind of the winning formula there. We tend to be much more founder-centric in the way that we invest, identifying entrepreneurs that themselves have identified that opportunity within a specific market or technology, and really kind of gain conviction in getting to know them and really understanding the businesses that they're building. So I would say, in terms of our thesis, again, a geographic concentration, but we are a little bit more of a generalist fund in the way that we invest.
Some terminology clarification, at least the way I think about it. To me, thesis is an idea or an observation about a market opportunity that then drives a strategy. So we have investment theses about markets and deals and businesses, but we have a strategy that drives how we operate the firm. So the thesis, there were kind of two pieces of the original thesis behind Primary. One, not unlike Lerer, was that New York, and it's rather shocking that when these two firms were started, which was 9 and 14 years ago or something, that New York was undercapitalized, because it's anything but undercapitalized in terms of is there a lot of cash kicking around? the city, obviously, but it was almost like early stage venture was like too small and too cute a business for, you know, the kind of big capital titans of New York to bother with. And so we had a thesis that New York City's, that market was going to grow and explode like Lerer did. And we've been, both of us were right about that, certainly. And then the other piece of the thesis was that at the seed stage, founders were being systematically underserved by managers who were choosing to take those guaranteed management fees and pay themselves like they might have paid themselves at the jobs that they came from, rather than building capabilities and operating support into the firm. And so from the get-go, we have been extremely operationally engaged with our portfolio companies, but that's not me as an investing partner saying, you know, pretending that I know a lot about how to structure your technology organization or what the optimal go-to-market strategy for your business might be or whatever. But I've got a team of seasoned C-suite operators who run teams underneath them around go-to-market strategy, about people and organizational strategy, around technology strategy, and around finance and capital strategy. And so we have, we're on our fourth fund right now, which is a $275 million fund, and when we get finished filling a handful of open roles, we'll have, I think, 44 people on the team, which is, you know, relatively unheard of size and scale-wise for a seed investor. And so those two observations led to the strategy, which is to be intensively focused on New York from our sourcing and servicing standpoint, and then to build this team and commit to very, very senior resources to lead that team, so that we can have an impact on the companies that we support, and then hopefully attract better founders who realize that that's a pretty good value proposition.
Yeah, so I'd add, at the firm level, there was a couple different insights we thought we had when we got started. They were all really authentic to our lived experiences, having been the young number twos building new investing businesses at large firms. My partner was the first hire at Google to build their investing business that became Capital G, and I joined a hedge fund to build their private equity business, and then went on to grow a holding company from 280 million of assets to 3 billion, called the Turning Group. And during that time, we learned a couple things. One is, as these firms scale, they often look to productize their people. That's the best thing for the management company. So when you cover fintech, or if you're in venture capital, you don't cover all of internet. You're assigned a couple subsectors, and your job is to drive throughput for the management company. Build a database, do the calls, log the information. And what we felt, and how we had to build our careers, was that the best investments actually sit outside the boxes that junior people are told to color within. And we were so paranoid about adverse selection that we didn't even look at the boxes. And so our best investments were companies in New York, like Peloton, that, in that case, right, is that a hardware business that a niche Palo Alto hardware fund should work with? Is it a content studio that Rupert Murdoch should own? Or is it an omni-channel retailer that Bain Capital should have backed? It's all of those things, but it doesn't fit neatly within the box, so it doesn't get covered well, let alone make the right decision to invest. And so our view on coverage was the antithesis of how most venture capital firms are run today, which is really around productizing their junior team. And so that was a big insight. I'd say the second thing that we felt strong conviction around was that the world was barbelling to extremes. So you have people with day jobs at companies who raise funds on Angels List. These are rolling funds. They raise them on Twitter. That world is exploding. And then you have firms like where my partner and I came from that had 5x assets in a short amount of years. And so the number one question I'd get as a partner and a member of the IC was like, hey, is that $10 million investment really worth your time? And in the middle, there were these great opportunities that firms had barbelled away from. And so we think about our business as really filling that gap with institutionally credible and sophisticated folks, if I can say that, who are also generationally relevant, right? We're not two young people like learning how to invest, but we're not kind of petering out at the tail end of our career. And we think that that dynamic combined with a couple other things makes for a really interesting partnership.
Yeah, so we like to call our investment thesis GASP, which is growth at a super price, because what we're trying to find is really well-run companies that for whatever reason have gotten kind of out of favor with investors and their own histories, and so they're selling at discounts to what they should normally sell for. And the discount has to be 35 to 50%. These are public stocks, right? So we're, as opposed to the rest of the crew here, we're kind of cruising around in much more sort of, territory where you can kind of, if you get it wrong, you can get out quickly. They don't have, the rest of the panel here doesn't have that. Your stockholders. But just to give you an example, Thermo Fisher, which is a big lab equipment company, and we bought it 10 years ago at 12 times earnings. And this is one of like the great life science tool companies. At the time, everybody thought the rest of the industry was kind of lapping them, but they had a very entrepreneurial management team, very focused on kind of building out their lab catalog business. And we've owned it for 10 years. We sold it just last year at 26 times earnings, and it was probably one of the best stocks that we've had. And so everybody thinks that value investing is very boring, like banks, insurance companies, and we'll have a few of those too. But our favorite ones are those that when we sell them, there's a tear in our eye when we're doing it. So anyway.
All right, thanks. So we're kind of at an interesting time now in venture markets in particular. I think venture investments were down more than a third last year, and that's a trend that's continued in the first quarter. So a lot of entrepreneurs are saying to us, yes, we know it's getting tough out there. I was hoping that Jim would talk about that, and also Brad a little bit, how this
and I'll
this
be
moment
quick
is
since I'm not
affecting your
really
work.
in the, I'm get the advantage of being an observer here, but I do actually, I sit on a couple of boards. One of them is, I'm an independent trustee for a couple of Blackstone direct lending funds. One of them is called Blackstone Private Credit, and the other one's called Blackstone Secured Lending, which is actually publicly traded. And so, just an observation on this, because you'll want these other, the rest of the crew here to really weigh in on it. But it's cyclical, and then I think the other thing is that the funding that is coming now from private credit, as opposed to just venture or private equity, is, I think, mollifying a little bit of the downside that you'd be sort of normally feeling, because there's a lot more funding available, and a lot of it's going into what they, these private equity firms like Blackstone and Apollo, and they all hit these, what they think are good neighborhoods, which, by the way, as a former energy analyst, that's actually not part of it. But there's now almost $1 trillion in U.S. direct lending money, and I looked at a McKinsey study here just before I came here. The venture money is only $1.6 trillion. So becoming a very large source of new capital, which I think we see a lot of deals, because I have to approve the deals as they're going through. There's a lot in the tech area, in particular tech and healthcare. And then lastly, this IRA is kind of pushing a lot of the venture money into the energy area, and so there's actually some growth there. So that's my 2 cents as a really from the peanut gallery.
So the key word that Jim cited was cyclical, and I think where we're at is a place that feels, frankly, catastrophically bad as compared to 2 years ago. But that's because 2 years ago we were at the peak of a cyclical bout of like true insanity. driven by, a zero interest rate environment. Money was flowing so freely. Investors, everything from Blackstone to Williams College to Prudential Insurance Company, whoever has these huge pools of assets that they're investing that drives all of our businesses, they were struggling to find places to generate alpha, to generate superior returns. And so venture was increasingly attractive. It was too easy for all of us to raise money, which meant it was too easy for entrepreneurs to raise money, which meant that there was like more and more competition for deals, which meant that the best founders were able to raise more money at higher prices. And that just sort of set new benchmarks at the market that everybody kept chasing and the money kept flowing in. And it was both exhilarating and exciting and important in the fuel it provided for a wave of, truly generational transformation, and some of the stuff that we're now seeing come to life in artificial intelligence in particular was fueled, 5 years ago by this incredible abundance of capital, and that's a long-term good thing. But when the Fed decided that inflation was getting out of control and they needed to step in and do something, that changed things very, very fast. And so starting in the fall of 21, the market started to pull back, and by the middle of last year, it was a very, very, very different game. And so last year was down 33%, but by the fourth quarter, I think it was down closer to 50%. And that's what we're going to see through this year. So that's the kind of gloomy view of it, and it is objectively harder for every founder to raise money, except for the most pure, perfect, incredible background people, can't miss type things. Founders, and I suspect in all of our portfolios, it's taken longer. And but that's not a bad thing. And relative to history, if you look at where we're at or what 2023 is likely to look like, in terms of total dollars invested by the venture capital industry, it's probably going to look about like 2019 or maybe 2018. And those were good years. We were all having a good time. We've been 10 years into, or 8 or 9 years into the kind of post-financial crisis bull run, and nobody was complaining in 2018, 2019 about, God, capital's too hard to come by, and it's a really grim environment out there. So I think it's important to kind of keep, we lost our heads completely, and it needed to change, and it did.
Thank you. In my observation, getting a job in venture capital, it's a great job, really cool, good to be on the cutting edge all the time, seeing new stuff that's coming. But these are hard jobs to get, is what I've observed. I was hoping that Isabelle and Marco might say a little bit about advice for students that would be interested in careers in VC.
Sure. Marco, do you want to start?
You go for it.
Okay. Sure. So I'll start with maybe a little bit more about my background, just so you guys, and this is not instructive by any means, but so you understand what that trajectory actually looked like. As I mentioned, I studied political science when I was here at Williams. I had a concentration in actually nationalism and political identity, of all things, but did a fair amount of, that concentration, a fair amount of statistical analysis as part of it, in addition to the political science coursework. And out of college, I joined the enterprise arm of eBay and did marketing strategy. I really loved this, and this was kind of the through line for my work at Williams. Really loved this idea of kind of what galvanized people, what drove movements within groups of individuals, and eBay at the time was kind of going through a little bit of a turnaround. Really found that kind of corporate trajectory was interesting. Anyway, it was the first job I had, and I was down in New York for that. And it was actually a little bit out of the blue, but a woman I had worked for had joined Yahoo as the CMO, and she actually asked me to join her to help build out the business planning and operations function within the marketing organization. And so started to, and it was not by intent, but started to kind of build a career in much larger kind of tech companies. Again, moving first from marketing strategy to then biz ops. And the, I would say like, so through that, really loved working in technology. I started to get to know different entrepreneurs. Or working at much earlier stage companies. And it was actually during my time in business school. So I went to MIT to Sloan after Yahoo, and during that time started to invest in those founders. Again, a little bit kind of circuitous, and it was all really about the people that I started meeting and getting really just excited about the type of work that they were doing. And started to do that more formally when I joined Dorman Fund, which is a student organization backed by First Round. I was a partner and then managing partner there, and started to do pre-seed investing, really in peers of mine, kind of other students that were building companies again while in business school, but really fell in love with kind of that earliest stage. Working with founders as they were building their businesses, as they were thinking through their business models, thinking through kind of the early go-to-market strategies, et cetera. And that is what led me to seed stage investing. So actually first joined Hippeau in between my first and second years of business school as a summer associate. Was asked to join full-time after I graduated, and I've been there again for almost 6 years now. But I tell the story that way, and then I think it's instructive, and this was, I think, echoed during the first panel as well. It really wasn't a kind of planned strategy that I had to get into venture. It was kind of pursuing different companies, different markets, different technologies, but ultimately different founders that I thought were really compelling. And I think that but again, an earlier panel was asked about how Williams set them up for success in their respective fields. And I would say for me, far and away, it's the critical thinking. And I think for me, it's using the qualitative and quantitative kind of skill set, that dual approach. But then also the constantly looking for what's interesting and new, and thinking about kind of what's driving new trends and groups of people, in thinking about kind of where there are new opportunities. And so that for me is that was kind of my particular journey. It's also it's a persona, it's an approach, kind of a stance that I think is really compelling when thinking about bringing new hires onto the team as well. People who think critically, but also are really interested and curious about where the world is moving and why.
Thanks. Marco, what advice do you have for students that are interested in careers in VC?
Yeah, mine will be less articulate, but I would say, just abstracting it away, so if you think about a team, the best teams really gap fill for each other, and what it means at the most junior level is that you're really doing stuff that other people can't do or don't want to do for whatever reason. And I was intentional, which is a little bit different, in knowing that this stuff really got me out of bed in the morning, and I would do anything to work in this industry. And because of that, I learned things and did things that other people didn't want to do. And so I would take that lens around it. So as an example, who here knows what NAND and DRAM is? Okay, one person, half a hand. So there were not really young people covering the semiconductor industry. And I recognized that as an outsider, and I knew that many of the great Valley-based firms had that as their core heritage, right? The firms that I started at. And there were not a lot of young people who wanted to work in that. They wanted to work in social, mobile, local was an interesting theme when I was coming out of school in 2006 through that decade that followed. And so I intentionally chose areas that would be high leverage to the partnership that not a lot of young people wanted to do the work around. And when I was in a position of power where I could choose where I spent my time, I then evolved into other things. And so that's also one approach. I'd say, Brad and I were talking about this, and I think I should give some advice too. A lot of people reach out and network, but I think being really thoughtful around it is important. Like, we don't need another email, neither do you, candidly. You should be enjoying your time too. And what I would say is think about what would be valuable on both sides in that interaction, not in a super transactional way, but there's always a way, like I value learning about things I don't know. And I'm sure a lot of you can teach me things. And so when I interact with students, that's my angle. What are they working on? What are they thinking about? We have a small team, small fee base. If there's CS majors here, maybe they could build a website for us and then come sit in our office all summer and that's your internship. That kind of stuff. I'd be really creative in figuring out a way that you could gap fill and push yourself to do that.
Brad, do you want to speak to this?
Yeah, I'll give you this is for me, but I bet it's relatively representative of the way a lot of people in the VC world. What's the perfect background? I'll tell you a perfect background. A top tier, a role at a top tier big firm that is exceptionally good at training analytical thinkers. So like McKinsey, Bain, Goldman Sachs, whatever. Knock the ball out of the park there for 2 years. Then get a job in a startup, probably in product management or marketing, because those are places that force you to be kind of broad thinkers about market dynamics and kind of competitive dynamics and who wins and why. Do that for a while, get deeply knowledgeable about a sector or two because you've worked in them, and then come call us. That's one flavor of it, but the point is, and Isabelle made a very good point, you've got to be curious, you've got to care about the technology, you've got to be passionate about that and demonstrate that, and then bring something to the table that we don't. I just hired a guy who's been a product manager at a supply chain software company for the last 4 years, and we've been spending a bunch of time exploring that space. Like what he brings, he knows so much about that market and the dynamics and the players and who wins and why that I never could get caught up on. But in 100 days since he joined us at the beginning of the year, he has catapulted me, 2 years forward in my learning. That's incredibly valuable. If he just came out of Williams and went to Goldman Sachs and then went to some other venture firm for a while, it's just not as valuable and expansive a person for us.
All right, so we're just about out of time. I did want to see if there are any student questions for the panel. Yeah, Michael?
Just out of curiosity, have either of you ever started a company or wanted to? And how important do you think it is to think like an entrepreneur when investing?
Either of us?
Yes.
Any of us?
I'll go first. Yes, I think it's super important to be entrepreneurial and if you're running a business or a leader in an organization.
I haven't, no, go ahead.
I've started 2. I don't get credit for it because I've started 2 venture capital firms. But I can assure you that having stared at cash flow that's running out, having not paid myself for several months so that I could pay the people that were working for me and building the firm, having raised money from people who had no good reason to give it to us, what Marco's been going through for the last couple of years, getting these things started, it's every bit as hard as starting an operating business. And then I did during the financial crisis, I would say the most valuable piece of my investing experience, the most valuable learning came from running a company for a year and a half that was kind of broken in our portfolio, and it was during the financial crisis and everything had slowed down and we just weren't doing a lot of deals, and so I got that CEO of a company that was about to fail, turn it around experience, and that was totally transformational in terms of building empathy with founders.
Last question.
Given the changes you mentioned seeing in the macroeconomic market over the past couple years, have you changed your strategies at all? And specifically for Marco, when it comes to health companies, have you shifted or seen a shift from visionary platform companies to more focused asset-based companies?
Maybe I'll start. So on the health side, I really accelerated my time in healthcare in part due to my wife. So she was one of the first product hires at Flatiron Health and ran their value-based care business. And then I backed her. She started a full-stack IVF business called Kindbody, which is now a big company that she likes to remind me has raised more money than our fund. It has 700 employees. And so that's a fun conversation at home. And that led to 6 or 7 other healthcare investments that were actually cash pay or consumer-facing businesses, but huge AOVs that weren't being filled by the market of healthcare providers.
Average order value.
Yeah, sorry, there. And with that, we then got exposed to infrastructure problems of those companies. That led us to a point of view on where in the stack we want to play. And so it's very specific. Now today, I think part of your question was where are you spending time in healthcare? We are focused on a few psychosomatic disorders that don't have a cure, things like anorexia and bulimia, things like pain management, where people would pay anything for a solution, but there isn't really a magic bullet, and the cost of care is so high and painful and taxing on the system. So there's a really big profit pool that is recession, resistant in some ways. Your anorexia doesn't go away, and so we pick and choose where we play, and I think that's the benefit, at least in our mind, of being focused on a specific wedge. So there's a couple areas like that.
Thank you, and I think we should wrap up now to make sure there's time for this last discussion, which will be very interesting. Will each of you be heading over to the blog? Will you be able to?
Quick.
Okay, so you'll be able to follow up with them over there at the log. Thank you.
Thank you.